Good afternoon. Thank you, everybody, for joining us. My name is Michael Del Castillo, Senior Editor of Forbes, where I help oversee our blockchain and cryptocurrency coverage. Here with Fred Shaw, Chief Risk Officer and Global Head of Operations at Hamilton Lane.
Yes, nice to be here.
Good to have you. And so we frequently have a chance to speak with the C-suite at Global Financials, but what we don't often have a chance to understand is a little bit about who they are. So let's take a pause now that our audience knows who you are, and let's go back in time a little bit. So, Fred, where were you born? Tell us a little bit about mom and dad. What did they do? And if there's anything when you think back to little kid Fred that sort of helps paint the picture of the guy that ended up being the chief risk officer at Hamilton Lane.
Okay, so I was born at Overlook Hospital in Summit, New Jersey. I have my parents, my father was a surgeon. My mother was a homemaker. And, I grew up in the bucolic countryside of Westfield, New Jersey and Watchung, New Jersey, sort of almost half and half there. And I don't know, as a child, I was very inquisitive. I liked nature. I spent a lot of time hiking, camping, doing things like that. I'm not sure if that toughened me up a little bit, maybe, to become the chief risk officer and in my future.
When you look back at those times, what's the first evidence that you see of kind of the beginning of an interest in global financial markets, investing, some of the big picture stuff that makes world finance tick?
Yeah, I think so. As a young age, my father was a firm believer that investing was important and was the way to help try and secure your future. And so when I was young, we would go through and look at different investment ideas, mutual funds and stuff for a little bit of money he'd set aside for me. And we would discuss why this made sense, how we do it. And then I would actually go through and with his support, obviously, and actually say, no, okay, let's buy $100 worth of this. I remember once for Christmas getting one share of IBM, right? Back when they used to issue actual stock certificates, and every company had their own design and all of that. And it was in my stocking of just one share of International Business Machines. And that was probably when I was 9.
I love it. And that did, in fact, blossom relatively early on into a career in finance. Looking through some of your past work, I couldn't help but notice one place that sort of jumped out to me. You spent some time at Stearns.
I did.
If you could briefly walk me through just what did you do there? And as Stearns was kind of going through its downfall that eventually triggered what we now consider the Great Recession, you had a front line seat of what was going on. I'm curious if there's one or two lessons learned that might have helped inform some of your future thinking.
Yeah, I think, Stearns, when things were going well, was a great place. And, I still have many people that I keep in contact from there. When I was there, I was in charge of overseeing compliance for the asset management unit, specifically some of the hedge funds and private equity funds that were sponsored there. I think, it was a very entrepreneurial place in terms of business development. If somebody came up with a brilliant idea, they were able to go and pitch it and try and develop it. And so that led me at an early stage to just try and really think through what the business is doing. How are they doing it? If we're going into a new area, if we're going into a new business line, what do I need to think about that maybe I haven't thought about before? And, I think some of that manifested itself in eventually what I ended up doing or what I'm doing at Hamilton Lane. But you kind of have to think through and try and see around corners, I guess.
What about, I'm going to push a little bit on that one. What about some of the possible market inefficiencies that you're dealing with today, specifically your work with blockchain, which we'll get to shortly, kind of reimagining the way that assets move from point A to point B, the way that money interacts with those assets, the way that global finance works. Was there a red flag? Was there an obstacle? Was there a problem that you saw during the Bear Stearns days that kind of crops up in the back of your mind as you're kind of reimagining the way things work?
I think it's important to think through and sort of go to the next level on certain things when you're reviewing them. I'm sorry, that's kind of nebulous. But what I mean by that is you can't just take certain statistics or certain presentations at face value and assume that all the relevant details are there. There are things that we would have thought about slightly differently back in 2005, 6, 7, had we thought about the way that the presentation is being perceived.
And so you're at Hamilton Lane today, but there wasn't an immediate jump from Bear Stearns to Hamilton Lane. Very briefly, set us up for how you got to your current employer. What brought you here?
So I left Bear Stearns in 2008, actually previous to the bankruptcy. I left a week before that, ironically enough, and joined a small asset management firm that no longer exists, where we were trading greenhouse gases and carbon credits and investing in emission reduction projects around the world. And that was sort of a lead into private assets, private investing. And then I decided to leave that firm. And at that point, I'd been in New York almost my entire career. And I decided to leave Manhattan and go to the wilds of suburban Philadelphia, where I found Hamilton Lane, who happened to be looking for a director of compliance at the time. And I had been the chief compliance officer of this previous firm that I was at. And I said, well, I know the area. I went to University of Delaware, so I'm familiar with Philadelphia. And I'm certainly no compliance. I can do it. And then I met the team there. And one of my hobbies, when I can get to it, is guitar building.
Oh, cool.
And Hamilton Lane is a very musically oriented firm. We have a company band. We have a lot of people who play various instruments. Our conference rooms are all named for either guitar manufacturers or famous guitarists. And we'll have their...
Who's your favorite guitarist that has a conference room named after him?
I mean, B.B. King.
All right.
Yeah,
cool.
I'm a big blues fan. So
there's a B.B. King conference room.
There's a B.B. King conference room, and Lucille's up on the wall.
Awesome.
Obviously a replica, not the actual one. And so, I joined Hamilton Lane as our director of compliance and sort of just steadily progressed from there, eventually became the chief compliance officer, then the chief risk officer, and also a couple of years ago started working with our operations teams to just help to continue to develop the strategy there.
And you've been at Hamilton Lane for, is it about a dozen years now? Yeah. I want to kind of transport quickly to the present day, but by way of getting there, let's look at those first 12 years, and let's talk a little bit about sort of like the one project, the one claim to fame, the one deal that you'd kind of like highlight, like to give our audience an idea of what has Fred accomplished and like what brought him to today.
I think when I joined, what I was tasked with was just building out we had an existing regulatory infrastructure, but we needed to build something more as the firm was growing rapidly. And so I think we built that, right? We hired the people necessary, we trained them, we brought in the technology that was necessary to make some of our processes that had previously been done through Excel or email to be much more tech focused, to make it easier for the employees and for the regulators when they come in. And so I think having successfully developed sort of a technical approach to the regulatory side of things, other things sort of meshed in there very nicely. Our operational due diligence team, they focus a lot on regulatory, operational, infrastructure type matters at the managers that we're considering investing with.
So chief risk officer finally gets everything de-risked. The system is strong, it's resilient, happy with the way business is going, $900 billion assets under management. Somebody comes up with a brilliant idea of starting to do some experiments with this terrifying new technology that's just in the headlines with all of these crazy scams and frauds, and we're talking blockchain here, right? I can only imagine what it must have been like as the chief risk officer for a company with $900 billion AUM the first time somebody says, let's start working with blockchain.
Yeah, so...
can you set this scene for us there? Let's go back in time. If you can remember specifically the first time blockchain was brought up at Hamilton Lane, at least to your recollection, and kind of walk us through a little bit of the exploration process, how you went from these headlines about crypto fraud and deciding that you were going to look below the surface and see what was there.
Yeah, so I'm happy to do that. One thing I'll just make a point of is the $900 billion number. It's approximately $900 billion, but it's not just assets under management. It's also management and supervision. So I just want to make sure we're clear on that. So the first time blockchain came up, and I'm going to be very specific to use blockchain, not crypto, because we spend a lot of time talking about the differences and why one does not necessarily equate to the other, was when we were looking at what some of our or other funds in the market like us were doing and what they were considering in terms of new products, new services, et cetera. And we have a very particular problem in private markets, which is the process to actually buy a private markets product is very archaic. It involves a very large subscription agreement that asks a bunch of questions, AML KYC review, and then various accounting matters. And we sort of looked at that and said, maybe there's a way to make this easier. Maybe there's a way to make this better. And so when we started thinking about that and we started looking at blockchain, there are some partners that we have chosen to work with who we feel have a really good tool to disrupt that sort of traditional access model into something that is much easier for people to use.
And so before we get to the partners and the actual process that you just recently announced, I want to talk a little bit more about the current system, about the way funds are built, structured, who the counterparties are, who the many counterparties are in some instances, where the delays come from, why the delays are there, if they're good delays. Sometimes not every delay is bad, So let's before we get into like how you guys started experimenting with possible solutions, let's go into some into the weeds a little bit here. Let's talk about the tech. Let's talk about the way that funds are structured today.
Right. Okay. So I'm going to paint a little picture for you.
All right. Cool.
So let's imagine that you have several billion dollars that you need to invest on an annual basis, and you want to invest some of that in private markets. And so you decide, okay, I'm going to invest in these 10 or 15 different private markets products. So you then have to go through that process that I just alluded to 10 to 15 times. You have to spend your weekends filling out subscription agreements that are they all look a little different, but they all ask the same questions.
Out of curiosity, these subscription agreements, are we talking about actual pen and paper here? Is there a digital contract sign? Like, how does that look?
Sometimes it is actual pen and paper. Sometimes it is done digitally. And it really depends on who's filling it out. So let's assume you're a tech-enabled guy. Okay. You're going to do it through a PDF with a DocuSign. Totally fine. Okay. But you still have 100 pages worth of questions and answers that you have to give to us. And so you do that once. And then you go to look at another fund that you want to invest in. Well, you have to do the same thing again. And you're going to read the questions and you say, I've answered these questions, but they're laid out differently or they look different. And so it's an incredibly inefficient process because you don't want to spend your weekends doing that. And so what we're trying to do is take that sort of very diverse but consistent process and distill it down into a process that really works. And if we can do that, well, then you don't have to pay your lawyers to review the subscription agreements that you fill out for us. You don't have to go through an anti-money laundering review. We have to make sure we know where you got your billions of dollars from, right? So if we use blockchain to do that, we can create a passport for you, in essence.
So let's pause and talk a little bit about those costs, because I think that's really important. So you just mentioned two, lawyers and anti-money laundering compliance. Is there anything else that we should add to complete the list of costs that go into creating and managing a fund in today's current system?
I mean, time is money, right? So you have to spend a lot of time filling these things out. So I would add there is an opportunity cost where you could be spending your time focusing on something else.
Is there any have you seen numbers out there? Do you have any internal numbers to give us an idea of what this cost is? If there's, say, like $100 million fund, like how much was spent to create it? Is any way that we can look at that more closely?
I don't have those exact numbers at the tip of my fingers. I would say it's in the probably sub $1 million. If you're a $100 million fund, something like that. Okay. It could be more. It could be much less.
So why does everybody have to fill this out separately? Why can't we just have one form that everybody is using? Tell me about is there I don't want to put words in your mouth, but it feels like there's a lack of trust here.
No, I wouldn't say it's lack of trust. I would say it's lack of a consistent approach to the same problem.
Okay.
Right. So private markets firms, there's a number of us, and we all have similar issues to face, but we approach them differently. Or subscription agreements are drafted by lawyers. Ask two lawyers to write the same concept for you and see if you get the same sentences from both of them. You won't. They just put them together differently. And so that goes back to the whole point of they're all asking the same questions. Yeah. They just lay them out slightly differently. And so nirvana would be to have that one consistent, the one document to rule them all. But we don't have it.
Now, last question here. Again, we're kind of like dwelling a little bit in the infrastructure, I think deeper than a lot of other people do. But we've talked about all of the different entities that are in place here. I just want to really be explicit here about sort of the role of what we would call sort of traditional centralized databases at each of these entities. So everybody is keeping files for their own records. Everybody is storing their own assets on their own records on a centralized database. The reconciliation process, auditing processes, how do we make sure, and why is it important? Is it important at all that everybody's files all say the same thing?
Are we talking about subscription agreements? Or
Yeah.
Okay. Well, yes, because there are certain qualifications that you have to have. There are certain representations that you have to give. There are certain bits about you that we need to know, right? We need to know who you are, where do you live, what is your banking information, who are your contact people, are you qualified to invest? Do you have the assets needed to tick the regulatory boxes that the SEC has put down to say, okay, if you can cross this threshold, you're eligible to invest in these types of private securities. And so, yeah, I think it is. We do need to know the answers, right? That we're not asking them because we're just curious. But I think that the way we ask them should be much more centralized and much more consistent.
So thank you for walking us through that process and a little bit of painstaking detail here. You recently made some headlines with, I don't know if we can call it an experimental fund. I believe it was your first fund that leveraged blockchain technology. First of all, if you tell us about the fund, all right, before we get to the technology. So tell us about the fund. What was it, and how would it have been structured, or was it structured without blockchain?
So our first foray actually was not, I think, the one that you're referencing. So the first thing we did was in early last year, we have a fund that's based overseas that we were able to tokenize a portion of with a partner in Singapore. Can I name the partner?
Please, yeah. That'd be great.
So the name of the partner is ADDX, ADDX. They are a Singaporean-based token exchange, and so we approached them with the fund that we desired to tokenize, and talked to them about how it would work. How would we do it? What are the steps? What do we need to know about? How does the whole process begin and end? And we spent a lot of time with them, many Zooms, late night Zooms, physical meetings in person over in their offices over there to get to know them a little bit better and let them get to know us. And then so that was our first foray into tokenization.
So, but it was a previously existing fund. And you used a word, tokenize. I want to look at that a little more closely because I know my editor, and he hears that word and he's like, what does that even mean?
Okay.
So you've got a previously existing fund for X amount of money, and you want to tokenize it, and you go to ADDX and ask them how. So what exactly does it mean to tokenize a fund? Are you tokenizing all of it? Are you tokenizing part of it? And what did you learn about the act of tokenizing by going through that process?
Yeah, so the act of tokenization is creating an on-blockchain asset that owns something that isn't on a blockchain. And so our fund is not based on a blockchain, but we wanted to try and provide access to it for people who were members of this exchange in Singapore in an effort to try and ease the entry process. And so I think it's important to note that the vast majority of the fund is not accessed through tokens. At least at this point, it is accessed through the traditional methods that I sort of droned on about before. But we are continuing to see, and ADX as the token provider there is continuing to see greater interest in accessing institutional quality products via this route that it distills that entire process that I laid out with the subdocs and AML, KYC, et cetera, into a buy button on your mobile phone. And you press that button, and because you've gone through a process with ADX to provide them all of the information that would otherwise have been resident in those other parts of the process, they don't need to ask you for it again, because they just send it to us. They say, here, this is everything about Michael. And we then have all the data that we need. We don't need to get it in the form of a subscription agreement. We get it in the form of what they give us. And it's very straightforward from our standpoint. ADX manages the tokenization. They manage the token issuance process for us. And then on a monthly basis, we simply see either greater flows coming in from ADX into our fund or funds flowing out if there's redemptions.
And so this was the first experiment. I keep calling it experiment. I don't know if that's the right way to.
I don't think it's. I mean, we believe that this has the real potential to disrupt the way people are accessing private markets and make it easier for groups to and less expensive for groups to access these products and services.
After you did that due diligence, after you went through that learning process, I'm imagining the mind of a chief risk officer. Did you come back with any concerns? Did you come back with any? Yes. Okay. So before you pulled the trigger on doing it again, which hopefully we can get to in a second, what were some of those concerns after that first meeting as the chief risk officer?
Right. Well, so when we started this process, I will admit I knew next to nothing about blockchains. I knew they existed, but I didn't really know much about them. So I had a steep learning curve that I had to get up just to be effective in thinking through this. And one of the things that was concerning to us is, well, what happens if somebody loses their token key or they can't get access to it? So we wanted to make sure that our investors were still protected and still had access to their assets. And so we went through that process. We understood what would happen. We realized that no, it's actually very straightforward, and we just reissue a new token if we need to. And we don't have all the issues that you would hear in the crypto space where if somebody had lost their key. So that was one of the focuses. The other is, the Singapore has gone about developing a regulatory infrastructure for blockchain. They're really focused on doing that. And so we were happy that the MAS had laid down.
Monetary Authority of Singapore.
Sorry, yes, the Monetary Authority of Singapore. Right.
That's all I do.
Had laid down this infrastructure for us to get a better understanding of. This group is regulated just like a stock exchange.
Yeah.
And so that gave us a lot of comfort in who we were dealing with and how they were being supervised.
So we've mentioned a couple different parties that are involved in this process. The regulators, ADX, Hamilton Lane, of course, the investors. Can we maybe give one example for one or two of those? You can pick whichever one of how the tokenization process is better. Again, how is it better for Hamilton Lane? How is it better for a regulator? How is it better for the exchange, for the investor? Maybe we don't go through all of those, one or two of your favorites.
I mean, I think obviously there's a massive benefit for the investor if we can drive tokenization and digital fund offerings forward, because we can adopt that consistent approach in not requiring you to fill out a 100-page document every time you want to make an investment. So I think that time, money, big savings for the investor side. From our side, we also don't have to review those documents and say, oh, it looks like this is wrong or this is incorrect. And because we have to, once we get the information, we have to process the information. So by using the blockchain, we're actually able to process the information much quicker. Reduces time for our own internal legal and external legal folks to review all the stuff, and I think that it's got benefits for both sides. It's rare you find a win-win. This one really is a win-win for both parties.
So you did your exploration, you brought home your fears and concerns, met with the team, came up with a plan forward for this first project, and then did it again relatively recently. So let's talk about the most recent tokenization of, I think it was, again, part of a fund, right? Tell us a little bit about that fund, and tell us a little bit about how was that different? How was it better? What did you learn from the first process that you changed a little bit the second time around?
I would say we followed a very similar playbook, but obviously this time we did this in the United States, and so we're working with a group called Securitize. And we met the founders through Victor Young, who is our head of digital assets in Hamilton Lane, who I partner with on these matters. And we were impressed at their investor base. We were impressed at the level of technical sophistication that they had in the interface and the process for investors to access the fund. And we thought that the fund that the Equity Opportunities Fund that we tokenized with them was a good fit for trying this out in the U.S. Because before what we did in Singapore, U.S. investors can't partake in because ADX won't take U.S. investors. But this one was again for the U.S. since we wanted to get our feet wet here.
So U.S. regulators and crypto are having a little bit of a moment right now. And I think, I don't want to ask you to opine on this giant quagmire that's happening. So I want to just pick out one point, right? There is a war going on, so to speak, between some regulators. Well, I'll say the regulators. I know you can't. The SEC and the CFTC are kind of competing over who has oversight of which assets, and perhaps most importantly for our conversation, which ones are securities, right? And you guys have kind of taken a different stance with this. I'll ask a dumb question because I want to give you a chance to kind of unpack it a little bit, but how many of the tokens that you guys are working with are securities?
So that is a very jurisdictionally specific question, but I would, based on my understanding of they're all securities.
Okay. Yeah. And
and that's how we treat them.
Yeah. So there's a lot of uncertainty about what is a security, what isn't. You're just assuming they're all securities.
We believe that no, I can't say all tokens. I'm not. I'm only speaking for what we've done.
Got it.
There are people who are smarter than I am who can opine on the tokens writ large. But for what we're doing, we treat them as securities. We believe they are. They represent an interest in an underlying security, and so therefore treat them the same way.
But to be clear, so there's the cryptocurrencies that help reward the miners that let the blockchains exist. For Ethereum, the cryptocurrency is Ether. And whether or not that is a security or not, honestly, that doesn't mean anything right now for our conversation. I'm more interested for the stuff at the top layer, the tokens that are built on top of the blockchains that you guys are using for your funds. Those are being built from the ground up to be securities.
Yes.
Yeah. And I feel like we've talked a little bit about this, but I really want to just bring a fine point to it. While everyone else is running around like chickens with their heads cut off, trying to figure out what's a security, what's a commodity, is there a need for a new regulation, is there a need for a third category? You guys have kind of embraced, they're all secure. The stuff that we're building is securities. What are the advantages to sort of embracing that is a security from the beginning perspective and going forward with a new horizon on the future?
Yeah, I don't think that topic never really was something that we debated. We always knew how we were going to treat them. We always knew what information we were going to request. I have never dabbled into what is a security, what isn't a security outside of what we're doing. That's not my background. It's not my area of expertise. And for what we're doing, it doesn't matter. So it's very difficult for me to opine on other things, but for us, it's very easy. It's very straightforward.
Once an investor takes ownership of a tokenized security, how is the experience different for them than in a traditional fund world?
Yeah, I think so. So obviously, they have the easier experience of actually acquiring the token by doing away with the process I outlined. And then otherwise, the other features of that token are going to be driven by the underlying fund that it's exposed to, whatever the liquidity is, whatever the lockups may be. If there are some private markets funds, you don't have the ability to redeem. You're in until we realize investments and we pay out your proceeds back to you. So I think that it really shouldn't feel that different for an investor, except the process of owning it is much easier.
What about the who? The who is owning these? Is that changing in any way? Are you seeing different kinds of people, different kinds of institutions who are buying into tokenized securities?
Yeah, I think that what we're seeing, traditional private markets fund have very high investment minimums, $5 million, $10 million, $25 million. What we are, and some of that is because with that process I outlined and all of the other bits that go into owning it, you don't really want to do it for a small amount of money. It's administratively burdensome. What tokens allow us to do is to make those administrative burdens much, much less, both on us as well as on the investors. And as a result, we're able to take in, as long as the investor is still qualified to invest in the product, and that's a sort of a different analysis, we can take them in at lower investment minimums. And so increasing the reach of private market assets to a broader subset of investors beyond the institutional investors that have typically driven private markets investing.
Is there any way to quantify that? I've seen some numbers thrown around, like average net wealth of investors without a tokenized security compared to average net wealth of investors with a tokenized security. Have you seen anything like that?
I haven't. Nothing that comes to mind. I think that it's more, there is a desire by more high net worth and sophisticated investors to access private markets. And in order to facilitate that access and make it easier for them to invest, we need to improve the processes. And that's really what we're focused on here.
Transition then into talk about secondaries markets in tokenized securities. Are there secondary markets? I'm assuming there are.
Yeah, there are.
Are they hosted by you guys? Is there a third party? Where do people go to trade these tokenized securities on secondary markets? And are we learning anything about how the behavior of those traders is different on tokenized secondary markets than traditional secondary markets?
So I am lucky that I don't have to deal with the trading of tokens. So ADEX in Singapore and Securities here in the U.S., they are token exchanges. They handle that in and amongst themselves. So if you're an investor in ADEX, you can trade around on the ADEX platform. But we don't actually have any visibility into that. The ADEX has a qualification process for their investors. They do all the reviews on their investors, and the investors there can trade bilaterally. Our products, we don't have trading turned on for the tokens. There are certain tax issues that can arise if you have tokens that trade that are otherwise invested in partnerships. We don't want to trigger publicly traded partnership rules or anything like that. And so we have not permitted it. But my understanding is that obviously there are tokens that trade. There are tokens that are out there in the marketplace that exchange hands. I have not played in those markets either professionally or personally, so I can't speak to it. But one of the topics that I hear is liquidity is a consideration.
Yeah.
Just because something can trade, will it?
Yeah.
And if you don't have, like I think of the New York Stock Exchange out of your beautiful windows here, you've got market makers there. You have specialists.
Yeah.
NASDAQ has market makers. And so there are groups that are just starting to explore that for tokens. And I think that in order for tokenization, trading of tokens to really blossom, you're going to need some of those intermediaries in there to provide liquidity when needed.
There's a paradigm where, let's say that for a given fund of $100 million, there's 100 investors. Every single one of those investors has gone through AML KYC. They can prove that they have gone through AML KYC. Those 100 investors could go to a secondary market and trade assets amongst each other without actually changing the net of the fund itself. But somebody could get out early, so to speak, on these secondary markets with assurance that they are still trading with a compliant investor. But you guys have decided not to. You have not activated the secondary markets trading feature yet. Talk to us a little bit about like what might happen, where you guys are in your development. Would love to maybe hear a little bit about like the where. Is there a blockchain center of excellence? Like who is doing all of this? What have you guys learned, and what's the future hold?
Yeah, so there's a lot there in that question.
All right.
I think that what we are learning is that tokenization does feel like it is getting a little bit more mainstreamed, right? You're hearing about it more. We know that there are a number of other parties that are out there in the marketplace right now looking at this technology and wanting to, other general partners like us that are seeking to utilize this route to allow investors to access their products and services. And I think, I can't comment on any of them by name, but we know that they are because we're talking to them about it. And so, interest is really high, and I think it's starting to get this critical mass that's going to allow it to blossom and, hopefully make the lives of the investors in this asset class easier longer term.
How does a world where one organization, Hamilton Lane, has tokenized part of one or two funds look different than a world where 100 GPs have tokenized 1,000 funds? What are the network effects of seeing that kind of adoption?
Well, I think that would be a great thing for the industry because it's going to make the processes that we have around accessing our products much easier. And I think that institutions can benefit from that just as much as high net worth, sophisticated, sort of private wealth investors can benefit from it. And so I think that it will become less expensive for investors to access this because that process comes with a time and money cost. And if we can do away with that, it just makes the investor experience, both from an ease of use as well as from an economic standpoint, easier.
Last question I want to follow. Do you guys have like a laboratory? Like, is there a team of people? I know you're working with partners. Like, what does that look like from a build perspective for a company like Hamilton Lane, and with an eye to maybe other organizations that are interested and kind of want to follow suit?
Yeah, we have created a focused team. I will say at this point it's rather small. It is myself, Victor Jung, who I mentioned, and then an individual by the name of Taylor Burns. And so we've sort of divvied up the work. Victor is out speaking to partners and finding and really testing the waters of who do we want to work with, vetting them, make sure we know who they are. Taylor's role is more focused on the infrastructure and actually making it work. Once you decide to do a token, we still have a number of administrative and operational processes that have to get done. And then I'm there to work with both of them to make sure that we're covering off our regulatory bases, make sure that we know who we're working with, have the executive level oversight over the process. I think, but that is just the team that is focused specifically on the digital aspect. There is a much broader team at Hamilton Lane, from our marketing and communications team who works with us on the collateral that our third parties are going to utilize, our operational teams, obviously, because we all have to make sure the funds are working for the digital assets to work on top of that. So I would say that while there's a very small team at this point focused on the actual digitization of the securities, there is a much broader team supporting them.
So digitization of the securities fits into the bigger team at Hamilton Lane. The bigger team at Hamilton Lane fits into the bigger picture of global finance. What trend are you seeing in global finance right now? A new development, a new problem, a new opportunity that has your attention most?
Yeah, I think it is. And so I'm just speaking from, I'm a private markets guy, so that's where I'm going to focus. It is this drumbeat of investors wanting more and more access to the investment returns that we can generate in the private markets asset class. And so that dovetails nicely with the blockchain topic, because I think something like that will be key to making it more accessible to these groups. And then also looking at the products and services that we have and that we develop, and starting to develop products that are specifically geared to that broader investor base.
What's your favorite guitar song to play?
I don't play guitar. I build them.
Wait, I thought you said you played guitar.
No, I build them.
You build guitars?
Yes, I don't play them. I can't play.
What's your favorite? Okay, so
I can bust out some very, very rudimentary stuff.
All right.
Yeah.
Electric, acoustic?
Electric.
Electric.
Yes. So,
very cool.
Thank you.
Thank you so much for your time. Hopefully we'll see you soon.
I hope so too. Thank you.